Diwali is always an exciting time for markets, investors. The mood is upbeat, but there's something different in the air this year ahead of Samvat 2080. I'm talking about the general mood in the stock markets, the idea and the belief that India is on the cusp of something very, very big, and the fact that we continue to remain the shining star among emerging markets and in a global gloomy space. We're talking to two very special guests today. I'm Tamanna Inamdar. With me is my colleague Niraj Shah. Niraj, this is beyond the usual happy Diwali kind of feeling, isn't it?
Yeah, it does feel like it. For us, even more so, a television station launch in the offing. So lots happening at our end too. But yeah, you're right. I mean, just so much happening around, and not just the domestic investors, which is the SIP flows, but large global heavyweights acknowledging the fact. We recently saw JP Morgan and others putting India in overweight position as well, despite the valuations. And hence, Tamanna, I think that this show, with two people who are astute investors, years of investing experience with them, and both of them have been for the last 12 to 18 months saying that there is something special about what happens in this decade in India, and which is why absolute pleasure to have in Hiren Ved and Sunil Singhania on the show today. Gentlemen, thank you so much for taking the time out, both of you. And at the onset, to you and your teams and families, a very happy Diwali and a great festive season.
Happy Diwali to you both and all your viewers.
Thank you so much.
Thanks, Niraj. Happy Diwali to both of you and to all the viewers. Happy to be here.
Thank you. Thank you so much. Lovely to have both of you. I'll go in the alphabetical order. Hiren, I'll start with you. What's your sense? Does it seem that while the signposts are talking of a lot of caution factors on the global front, could India do something special in this Samvat as well? Upcoming Samvat, I mean.
Yeah, I mean, I think the domestic economy in relative terms seems to be doing very, very well. We obviously have to be cautious about geopolitical challenges, energy prices, and so on and so forth. But I think the Indian economy today, from a macro perspective, is far more resilient than it was in previous cycles. So it's not as if that we've not faced some of these uncertainties before. It's just that today we are far better equipped to manage some of the shocks. And that's what is being reflected in the resilience of the market, in the resilience of the corporate sector. And I don't see that unless there is something which is really out of the ordinary. I think this strong footing into the next Samvat year should definitely continue.
The question really is, and I'll come to Mr. Singhania with this, are the numbers holding up the sentiment? The sentiment is positive. India trades at a premium. Valuations are being talked about a lot. From what you've seen in corporate earnings, Q2, etc., do you think that the facts hold up? Are those performances holding up in your view?
I think totally. So if you look at the June quarter numbers, I think after 6-7 quarters, we had earnings which came in better than analysts expected. We had an upgrade of Nifty earnings to almost 1100 to 1125 on an FY25 basis. The September earnings are almost getting done. The sum total of earnings so far has been a slower sales growth, maybe mid-single digit, but on the operating profit and the PAT side, profit growth have been like 20 to 30%. Obviously, the naysayers might say that it has been contributed by a few sectors like financials and so on. But the fact of the matter is that even after September earnings, our view is that there might be a further 3 to 5% upgrade as far as earnings are concerned. And if you just hold on to these earnings without the upgrades, on a March 25 basis, we are, as I said, 1100 to 1125 as far as Nifty EPS is concerned. On a September 25 rolling 12-month basis, which is what now the analysts have started to discount, we are almost at 1175 to 1200 rupees as far as Nifty earnings is concerned. And all that means that we are trading at a 16.5 times Nifty P multiple. which is exactly on a 10-year average. So we are not cheap, but we are not exorbitantly expensive. Yes, there are pockets where the numbers might look a little bit wacky, but overall, market as a whole, I think we are fairly balanced. And given the trajectory of the GDP growth, which we are expecting, and as also the outlook on the corporate profit from a 2-3 years perspective, which is clearly mid-teen kind of profit growth, I think we are pretty fine even on the valuation front.
I'm going to take that valuations question to Hiren as well. Do you agree that we're expensive but not exorbitant yet? There is some steam left?
Yeah, see, I think, this whole valuation question has to be looked in a certain context. Now, when we say we are expensive or cheap, we typically tend to look at the last 5-year or the last 10-year average, right? And the question we got to ask ourselves is that, do we believe the next 5 years or the next 10 years are going to be better than what we've seen in the last 5 to 10 years, right? So if the answer is yes, then I believe that there is a case that we trade at a reasonable premium to the last 10-year averages, right? And as Sunil just now mentioned correctly, that we are not cheap, but neither are we expensive. And if you go back in history, India has been very cheap whenever there has been a very large crisis, right? So in 2008, when the market crashed, we typically tend to bottom out at 10 to 12 times earnings. Now, can we foresee that something like this can happen? Nobody knows. And therefore, if you're going to wait to invest in a market which will be really cheap, then you really have to wait for a big crisis to play out. And for which neither I nor anybody else with any reasonable sense of imagination can predict today. We don't wish it, but I do believe that at least I have the confidence that corporate balance sheets today and for the next 5 to 10 years are going to be better than what they were in the last 5 to 10 years. Bank balance sheets are today better than what we've seen in the last 5 to 10 years. And the second thing to remember is that I think post the global financial crisis in the run-up to 2020, right? Generally speaking, we had a lost decade of manufacturing. We had a big banking NPL problem. We had corporate balance sheets which were levered. And we really didn't have an investment cycle that was kicking in. I think all of that has reversed, right? So I think we are likely to more see a scenario like the 2003 to 2008 kind of bull market, minus the crazy leverage and hopefully better capital allocation by corporates, unlike in that cycle where everybody went and acquired trophy assets globally and those returns never panned out. Hopefully, corporates have learned from that lesson. They've lightened up their balance sheets, they've delevered their balance sheets, and hopefully in this cycle, investment cycle, they will make better capital allocation decisions. So I do believe that with relative growth being strong, our demographics being good, the kind of flows that we are seeing from the retail investors into the equity market, something that we were wishing for many years, I would make a very strong case to say that why can't Indian markets trade at a reasonable premium? I'm not saying a wacky premium, but a reasonable premium to last 10-year averages. I think that it's a reasonable case to make. So I don't get, I don't get mired by this whole trying to look at valuations within the last 5 years and last 10 years, right? The context in the last 5-10 years is very different from what we believe could happen in the next 5 to 10 years.
Okay. Let's talk beyond numbers. Sunil's weekly messages talk about what we are seeing and how a picture says 1,000 words. So Sunil, you gave an answer on the numbers. Now let's talk beyond numbers. For you, what are those critical signposts that you're watching over the next 12 months, which will enhance or reduce your attractiveness quotient on the Indian markets?
So, Niraj, I think we all agree that India is in a very sweet spot. I think to some extent we can call it we are on an autobahn, super highway, and waiting to just surge ahead. On the other hand, you have headwinds coming in from the overseas side. So headwinds are of two kinds. One is obviously the macroeconomic headwinds of what is happening in terms of slower growth in developed world, particularly Europe and US, sticky inflation, high interest rates, and so on and so forth. And the second headwind obviously is coming in from the geopolitical concerns. So we had Russia, Ukraine, and China, Taiwan, and now the West Asia, Israel and Hamas issue coming in. And I think all this means that, what we are seeing in terms of sort of a tailwind from a domestic India perspective, it is getting to some extent, met by headwinds from the global side. From an India perspective, obviously, elections is going to be a major thing to watch out for. And, it seems to be less of a worry, more likely a scenario where, you have a continuity as far as the government is concerned. And I think this third term can be very different in terms of the focus on development and growth is concerned. We saw the first term going into cleaning the system, NPAs and GST and DeMon. Second term half went into COVID. It's only in the last 2 years we have seen the fruits of the push towards Make in India, PLI, defense, and all those coming up. Our view is that the third term will take this growth and the push towards, real manufacturing and infra growth forward, and that can be really revolutionary. On the other hand, on the global macroeconomic front, things are easing out. Our internal view is that given that commodities, whether it's agri, metal, and even oil, having corrected, base effect, which is now going to work in favor, and also now for a change, real estate prices in the US coming down. And real estate prices are a key component of inflation index in the US. I think we'll start to see surprises on the inflation numbers as far as US is concerned. And maybe in the near term, we have peaked out as far as interest rates in the US is concerned. So I think if you have a little bit of, the headwinds going away and sort of converting into tailwinds on the macroeconomic factor, then the only thing to worry about would be elections domestically and the geopolitical issues globally. And given the fact that India stands out in terms of one of the very, very few large economies in the world, which have done very well even in the challenging times of 21, 22, and 23, and looks to be the fastest growing economy for at least the next few years, I think the stars are aligned. So we just have to be positive and ensure that we don't mess up.
It's interesting. It's the third time or the fourth time in this morning that I'm hearing and using the term "the stars are aligned." That's pretty interesting. Hopefully, it works that way. Sunil, just one quick follow-up here on the since we're talking numbers. Let's assume that there is no election worry per se, continuity. We know that the domestic SIP flows are there and stable. Let's assume that is going. What has not worked is foreign flows. Now, if indeed those return, is that a big trigger point for what Hiren said, which is that why can't valuations be above normal? Would it need for foreign flows to be meaningfully strong into India for valuations to be above normal? Rightfully so, maybe, because it may be the only beacon of growth in a growth stout world.
So Niraj, we have done as a market superbly well, despite the fact that foreign flows have been negative. And other than the April to August period where we had strong inflows, I think over the last 24 months, we have seen constant, outflows from the foreign investors. And it's a combination of a lot of things. I don't think they're negative on India. I think they also get a little bit worried when all of us say that valuations are expensive, and they also hear and read what we have to say. The other thing is, I think China has not done anything. And emerging market index has been flat last 10 years. So there's been a massive, I would say, redemption and sell-off from emerging market flows. The other thing is the world has been very volatile and very challenging. So in a scenario where US bonds are giving you 5% yield and dollar keeps on appreciating, there's a natural tendency for investors not to take too much of a risk and just park the money in US bonds. But I think all this would change. And if foreign flows do really start to become positive, imagine what will happen. So right now, you have supply coming in from foreign investors and also a little bit from the companies themselves in terms of fresh issuances and getting absorbed by domestic investors. If foreign investors also start to become positive, then, you'll have like what you call a double engine in terms of the flows coming in. And foreign investors flows, at least from our perspective, we are very, very confident that they will turn positive. I think this is a period, November to March is a period where large foreign investors rebalance their portfolios. Our indications over the last 6-8 months clearly point out, our interactions with even some of these allocators clearly point out that most of them are looking at increasing their weight to India. There's also a new class of funds coming up, which is emerging market ex-China. And that that class is growing. And there India's weightage is upwards of like 25%. I think as that class becomes popular, because global investors want to get away from China for a couple of reasons. One, they are not confident on a geopolitical front. Second, the returns have been like dismal, 1 year, 2 year, 5 year, 10 year in China. I think India will start to get a fair amount of inflows, and that should be maybe an added trigger for the GDP to maybe inch up beyond 6.5-7% to maybe 7.5-8%, and market also to respond slightly better. See, markets are never fairly valued. Markets will either be undervalued or overvalued. Right now, we are fairly valued. It is always possible that we get into an overvalued zone, and we can see that happen maybe over the next 2-3 years, and that should be pretty, I would say, welcome from all investors' perspective.
So, Tamanna, it's interesting that India deserves to maybe trade at a higher valuation premium. And on this show, at least we are saying India is not expensive. Let's not repeat that so that people hear that India is expensive, maybe on a relative basis. Over the next 5 years, it's
not exorbitant. I like that term which Sunil used because there's a bit of nuance between exorbitant and expensive.
Yeah.
Expensive can be something that's worth it. Exorbitant means you're not sure whether it's worth it. But, Sunil talked about double engine in the context of FIIs coming in. It's the season for that term, though in a very different context. I'm going to come to Hiren, as we'll hear double engine sarkar perhaps in a lot of rallies. I want you to clear up for me one ongoing debate. Do the December 5-state poll results matter or not in the long term? Is it going to be, if the results are not as per the market expectation, an opportunity to buy going into next May? Or is this, in the larger picture, not such a big event?
Look, I think we all know that, the kind and the quality of work that this government has done, right? Now, if you really ask me about the big picture over the last 10-20 years, we've seen several governments. We've seen coalition governments, we've seen UPA, we've seen NDA, and I'm not getting into the politics of it. But I think that on one hand, we can't say that there are structural factors driving growth in India. Yes, there can always be policy impulses that can accelerate the benefit of the structural factors, right? So in the long run, it's not going to matter. But would it be fair to say that people will be looking at the elections in the 5 states keenly? The answer is yes. Everybody wants to be convinced that the continuity that we all want in going into 2024, we do get a clue. However, we need to be careful about the fact that even if there are reverses in the 5-state elections, right, we must understand from the trends in the last few elections is that the Indian electorate differentiates between central elections and state elections. A lot of local factors play a role in state elections. There are other factors that play a role. But to me, it looks like that at the center, there is a very, very high probability that we would see a continuity. But yeah, I mean, those few months or weeks when results are out, people will look at what is happening. But a lot of these things get discounted very fast, and they really don't play a role in the long run, because in the long run, what matters is growth, cash flows, profitability. And if that happens, then whether it is A or B or C, eventually that gets reflected in the valuations. But yes, temporarily there can always be volatility. The market has the right to discount something that is expected. If something unexpected happens, that will get reflected, but it's not going to matter really in the long run, frankly.
You know, we've spoken a lot about the big picture, the big events looking forward. Let's get a little more specific, because viewers want to know that, especially from our panel today. And Hiren, I'll come to you on this. What are the themes that you think will carry forward into the next 12 months and which will be discarded? I'll just talk about two. The excitement in mid-caps, do you think that goes forward? Reality, for example, do you think that carries forward?
So again, right, I mean, when you talk about mid-caps, right, I think if you generally look at it over a fairly long period of time, small and mid-caps have compounded at a better rate than the large caps, because they are like an operating leverage on growth, right? So if we are confident that the breadth of the economy will grow and manufacturing will do well, right, then I think mid-caps will continue to do well. Yes, there may be some pockets of overvaluation. That always happens. When a certain segment of the market does well, there is always some element, small areas of froth that might come through. But there are 2-3 reasons why mid and small caps are doing well. One, I think that the breadth of growth in the economy is much more wider. Secondly, a lot of the manufacturing companies, a lot of the new emerging growth areas are in companies which are today small and mid-size. You don't have large cap representation in many of these opportunities. And therefore, if investors want to play that growth story, they have to start with those small and mid caps, right? So I do believe that while there can always be short-term corrections or, time-wise corrections, broadly speaking, our thesis is that as the economy grows and the breadth of the opportunities expand, I believe that small and mid caps will continue to do well. There can be intermittent periods. Markets are cyclical. There, just like it happened last year, where between September to March, the broader markets corrected. And then from April, May onwards, we've seen a big rebound in the broader markets, right? So those small cyclical moves can always happen. But structurally, I believe that as the breadth of the growth improves, small and mid caps will do well and will continue to do well.
Okay. Now, just before I come to Sunil, and then we'll wrap up the show with Sunil's thoughts, but Hiren, just a quick word. So that's the broad view on, let's say, mid-caps, but within themes, you were amongst the earlier ones to identify you talking about the manufacturing renaissance. Those stocks have done really well. From here on, let's say, not just for the next 12 to 24 months, what themes look the best to you?
So look, I think, manufacturing continues to be a long-term theme, right? But it's also fair to say that the market valuations in some of those are also reflecting that optimism. If I were to take a purely tactical view over the next 1 year, I would say that some select areas in discretionary consumption which have not done well this year, because consumption at the lower end, general small ticket consumption has not done well. I think it is fair to say that in India, you can't rein in the consumer. If we believe that there will be a trickle down with all the improvement in manufacturing and infrastructure spending, then I think next year you will have a very favorable base for discretionary small ticket consumption. And if those stocks haven't done well, tactically, I think I do see opportunities where you will have a better base effect next year, right? So while structurally I continue to be positive on manufacturing, defense, electronic manufacturing, all the themes that we've talked about in the past, there are always nuances, right? For example, specialty chemicals hasn't done well over the last 12 months. At some point in time, that will base out. Discretionary consumption hasn't done well. So, active managers will find opportunities where the risk reward will be better. But on the whole, I continue to be very positive on the manufacturing theme.
Okay. Sunil, the common joke amongst a lot of dealers who I talk to कि Abacus के नाम इतनी deals में आता है कि पता नहीं चलता है कि सुनील सिंघानिया को क्या पसंद है. So let's use this show to understand कि सुनील सिंघानिया को क्या पसंद है. Let's say from a next Samvat perspective, or as I asked Hiren, from a 24-month perspective as well.
See, frankly, I don't think investment can be changed or focused on a one-year perspective. It's very, very tough, and particularly in this dynamic world where things are moving around, so much. I think it's very, very difficult. But the fact of the matter is that we all believe that the growth in India is for real. It is sustainable, and therefore this $3.5 trillion economy going to $6-7 trillion over a period of time is definitely possible. And as I mentioned earlier, I think the next 5-year term is going to be very different, because a lot of things where we needed to focus on, but which we couldn't, like manufacturing, which Hiren mentioned, or even infrastructure, or even the whole, move towards uplifting the standard of living of the entire nation. I think that itself gives you themes, So obviously, manufacturing is going to be good. Financials are always a good theme. I think India is a base of knowledge. So, pharma, both from a domestic as well as from a global perspective, looks good. As I said, the standard of living of the entire nation would move up as we move to $5-6-7 trillion, because our GDP will start to inch up towards $4,500 per capita, which is where the actual, the consumption and the want-based economy starts, which is a big trigger. So anything to do with high-end consumption or consumption other than the needs, I think that can be a great 5-7 year theme. From a 1-year perspective, I think it's going to be the same. I think we all have to be positive on India. We are fortunate that, we are in a phase where the world is struggling, and we as an economy has actually got things right. And I think if you keep positive, then, you just have to ensure that you are in good stocks.
Though I will ask you one more question, Sunil, from a 1 year's perspective, and specifically only what is happening with large caps, which didn't really fire through this last Samvat. They've stayed steady but didn't really fire. When we're talking about, a double engine, do you expect that to change as well? Or is that something which will take a longer time?
I think on a 1-year basis, large caps have been pretty okay. Maybe, low double-digit returns, which is fine, which is, mimicking the profit growth. Our view is that going forward also, the profit growth should get mimicked in the returns. But yes, when foreigners are selling, because of their size, they are predominantly invested in the larger companies. So there's more pressure there, and domestics, normally we see the flows come into the broader markets. I think as and when the foreign investors start to reverse their stance, maybe there will be a catch up as far as large caps is concerned. But, I think this debate about large cap, mid cap, small cap has been happening for the last 20 years, at least in my career, and it keeps on happening. It is very clear that large caps offer you stability. They give you, obviously, returns. The mid and small cap will give you higher returns, because by nature, these are entrepreneur-driven companies in smaller upcoming sectors. They will tend to grow faster, but with more volatility. So as an investor, I think you have to have a combination of both, where large caps give you stability and mid and small cap will keep on giving you the alpha.
All right. On that very optimistic and positive note, we want to thank you, Sunil and Hiren, for joining us on the show this evening. And very, very happy Diwali to you from the entire team here.
Wish you all the same. Thank you.
Thank you. Thank you.
Thank you, both of you, and viewers. Thank you so much for tuning into this episode. And if you're watching this from Tamanna, me, and the team that puts this show together, and the whole BQ Prime family, wishing you all a great Diwali and a prosperous New Year.